Hey, listen, this is not financial advice whatsoever. You do what you have to do. What's going on, guys? Welcome back to my vlog. Listen, in today's video, I'm going to talk about some weird stock market indicators that people use and have been using for quite some time. Now, you might have heard of the regular ones that people use all the time, like the moving averages and the MACDs and whatnot. People use all sorts of very common indicators, but I found some of the weirdest ones out there. These are absolutely weird. So if you like this kind of stuff, stick around because this will be fun. I will give you the weirdest one I found so far at the very end. So stick around because it'll be fun. So let's move on with obviously number one. And that is, boom, the Super Bowl indicator. What the hell could this possibly mean? Let's take a look-see here. The Super Bowl indicator is the belief that if the AFC wins the Super Bowl, there will be a decline in the coming year. And if the NFC wins the Super Bowl, the market will be up. The results of this are actually pretty surprising. Of the 22 NFC wins, the S&P 500 has an average up year of 12.3%. Of the 14 AFC wins, the S&P 500 has had an average down year of 4.8%. Now, this can be argued. Again, I'm just presenting you with some of the stuff I found. You can argue back and forth if, that's actually correct or not. There have been some arguments against this. So it says right here, this is for the Dow, and it's a crappy image that I found. This is the best I can do to make it look pretty. So if you can see here, AFC wins versus NFC wins, average return 5.2 for AFC, 10% for the NFC. And they go on with medium returns and percentage positives. So again, you could argue if this is accurate or not. I'm not really arguing the accuracy of it. I'm just really intrigued by some of these indicators that people use. And they do use them, believe it or not. Number two, moving right along, guys. Presidential election cycle theory, okay? This is an actual indicator that people use. This right here shows you the presidential election years throughout history. So new president elected, boom. Look at the stocks. So the stocks are by the represented by the orange and the bonds by the yellow. So, okay, all presidential election years. And then right here is the incumbent president wins. So look at that. In 2016, Lee Bohl, a Charles Schwab researcher, analyzed market data between 1933 and 2015 and found that, in general, the third year of the presidency overlapped with the strongest market gains. I don't know why I put that further. Ignore it. It doesn't exist. Anyways, the S&P 500, a fairly broad index of stocks, exhibited the following average returns in each year of the presidential cycle since 1933. And then they give us this data here. Year after the election, you get a gain of 6.7%. Second year, 5.8. Third year, 16.3. Fourth year, 6.7. Again, this can be argued a little bit because then you have certain situations like, in '08 and stuff like that, the market crash. But anyways, it's because it's weird, not it's because it's accurate. That's what I'm bringing to you. So, number three, sell in May and go away. I like the title of this one. The stock market posts its weakest returns from May through October, suggesting that investors should lighten up on stocks during that 6-month period. Since 1945, the S&P 500 has averaged a 1.4 return in the May through October period. November through April, returns averaged 6.6. So maybe it's something to consider here. And now we go on to number four. See, I'm moving right along, just pushing right along. I don't want to waste your time. As goes January, so goes the year. So this is a theory that January kind of dictates the rest of the trading year. But, again, you can argue that it's accurate or it's not. Again, this is just the fact that it's weird. And this one basically is the following. The stock market performance in January tends to predict calendar year performance. Could be true, could not. It's up to you. Since 1946, a positive January return in the S&P 500 has resulted in an 11.1 average gain over the next 11 months. A January loss has resulted in a 1.3 average gain. So, January dictates the rest of the year, I guess. And this one, I found a little piece of information that kind of argues against this. It says the January barometer hasn't been as accurate lately. And then this gives us some examples, like in January 2003, that month was a negative 2.7, but the other 11 months actually returned 29.9%. So pretty good. 2005, same deal. 08 though, again, that's a whole different scenario. That was, insane. But then look at that, 2009, 2010, 14, 15, 16. So again, you can argue that this is not accurate at all, but it's just the weirdness that we're discussing here, okay? Not the accuracy, because you can take these and run with all sorts of different informations depending what you plug. And now we move on to number 5, and this is the absolute weirdest one that I found so far. If you have a weird one that you like to share, please post it in the comments section, and that is moon phase indicator. This is an absolute weird indicator, but believe it or not, it seems to be fairly accurate. Again, you can argue that it's not, but let me give you some information first, okay? The moon phases are often used to analyze stocks and the foreign markets. On the chart, the presence of a dark circle shows a full moon, while a bright circle indicates a new moon. Let me show you an example. Boom, right here. Now, I'm actually going to show you an example on how you can look up this particular indicator, okay? So here we are. Let's say, for example, you want to see the SPY, okay, the S&P 500 ETF. And let's pull up some indicators here. And let's type moon. Boom, right there, moon phases. Okay, we got that right there. Let me give you a full screen. And look at that. So this right here represents a full moon, and the brighter one represents a new moon. So as you can see, let me see if I can go back a little more. It's weird. Like I was studying this the other day, and it's absolutely, it's kind of accurate to a certain degree. So every time you see a dark circle, obviously it indicates a full moon. It indicates a move up. Okay, look at this. And when you see the new moon, it indicates a slight movement down. Now, as you can see right here, so full moon and then new moon. Okay, the brighter white one is the new moon. The darker one is the full moon. And allegedly, every time you see it, it's supposed to make the market go up, but it's not always accurate. So again, people use it, and you can see some patterns here. For example, like here, you saw that it was going to go up, and then you see the new moon down. Okay, full moon up, new moon down. Okay, so again, it's, you got to really take these day by day, because sometimes they're not accurate, or not day by day, but every time you see a new moon phase. So believe it or not, people actually believe in this. And again, I'm not saying they're right, I'm not saying they're wrong. I'm just saying this is a weird indicator, okay? So I just wanted to make this video. I think it's kind of fun just to see the different indicators that people use. You can have your own. If you know any weird ones, please definitely let me know in the comment section. And that's it for today, guys. Just a weird, kinky video, I guess. I don't know if kinky is a word, but still, damn. Take it easy with your wording, Louis. But it's a weird video, I know. But I thought it was fun to kind of go over these. If you liked the video, hit the like button. If you didn't, I am so sorry. I apologize for my existence. And I'll see you guys in the next one. Peace.